Okay, it's about time. Let's get started. Good morning and welcome everybody to our webinar today from the day trading series. Today we open chapter 3, developing a profitable trading strategy. And as you can see, today we'll cover part 1. So what we will talk about today is the 7 steps how to develop a profitable trading strategy. Since we are somewhat limited in time here, so we have the next 30 to 35 minutes, because the moderator asked me to leave some room for questions and answers at the end of the session, since we have some pre-registered questions already, not answers. All right, I'll try to be very brief, and we'll cover a lot of material here in the next 35 minutes. What we will then do in the next webinar that's coming up at the beginning of March is that we will actually use these 7 steps that I introduced here today to develop a profitable trading strategy. And most likely we'll use the euro currency versus the US dollar, or we might use one of the futures market, depending who will attend the next time and what your interests are. I'm Markus Heitkoetter, the CEO of Rockwell Trading. I want to welcome you to this webinar, and I thank fx3.com for having me here. Again this morning, I'm here, a regular visitor, been conducting webinars for fx3.com now for more than a year. I think we are coming close to 2 years already. Okay, so what are we going to talk about today in detail? And I hope that you see the next slide right now. You should see a slide where I talk about the 7 steps how to develop a profitable trading system. The first thing that we need to do, somehow, of course, we have to start with an idea, and we'll talk about this here in a little bit. Then we select a market. After this, we start selecting a time frame. We then need to define our entry rules based on the original trading idea that we had. We'll need to define the exit rules, and I'll show you the 3 types of exit rules that you need to apply when trading a system. We'll talk about how to evaluate your system and, of course, how to improve the system without curve fitting it if you're not happy with the results that you achieve when evaluating your trading system here. All right. So you know that this is the 3rd part of our day trading series. So let's do a very quick recap, because it never hurts, even if you have heard it before. Here are the top 6 reasons why traders lose money. The top reason is that traders do not have a trading plan. Or even if they have a trading plan, there's a lack of discipline to actually follow the plan. And I just got out of a live trading room that I was moderating here a couple of minutes ago. And all the participants in there have a trading plan. Believe me, they're my students. However, there was this one fellow, this one trader, who couldn't follow the trading plan and got carried away with his emotions. So very important, having a trading plan and having the discipline to follow the plan. Today, we will work on a trading plan. And in the upcoming sessions, we'll then talk about how to develop the discipline to follow the plan, and also how to control your emotions, because our emotions are the main reason why we deviate from our trading plan, why we are not following the trading plan, because we're getting greedy, we're getting excited, we're getting fearful of pulling the trigger. Reason number 4 why traders are losing money in the markets is the failure to accept and limit losses. You know that as a good trader, you need to have a stop loss in the market, and it should not be a mental stop loss, it should actually be a stop loss that is in the market. Great traders also have a profit target, and we'll talk about this today. No trading plan is complete without a profit target. As soon as you enter a trade, you should know when to exit a trade, when to exit with a profit, and when to exit with a loss. So having a profit target is a vital part of your trading plan. Reason number 5 why traders are losing money is the lack of commitment. Trading is a business. Trading is a serious business. We are not talking about gambling here. If you want to succeed with trading, you have to invest the time and effort that is needed in order to succeed in the market. This means that you are attending here webinars like you have on fxstreet.com to complete your education. Yes, you have to educate yourself. You have to acquire certain knowledge. It is not enough just to read one book and then get started with trading, or I don't know, maybe you have bought a magazine or watched an infomercial or something like this. When you are trading, okay, it is a process of learning, and every day you're gaining experience. So please be committed and be committed to your trading plan, because as you have just seen, losses are part of our business. Sixth reason why traders are losing money in the markets is overtrading. I'm talking to many traders on the phone who make money in the mornings and then give it back in the afternoon. Or maybe they made money on Monday and Tuesday and they give it back on Wednesday, Thursday, and Friday. Please make sure that by all means you avoid overtrading. Good amount of trades that you should place every single day is anywhere between 2 and 8. If you're placing more than 8 trades, most probably you're overtrading, and we'll talk about this in upcoming sessions. All right. Last week we talked about the 3 steps to success, and this is very important that you all keep this in mind. So what is the first step? You want to define your goal, and you define it as a SMART goal. So you want to have your goal specific, measurable, attractive, realistic, and it should have a time frame. A fantastic thing is when talking about trading, this is what we can do, because we can say we want to make $5,000 a month, or we want to make $10,000 a month. Is this specific? Absolutely. We have a dollar amount here. Is this measurable? Sure. Look at your account status at your account balance at the beginning of the month and at the end of the month, and you'll know whether you have achieved your goal or not. Is it attractive? Well, it depends on you. If $5,000 is attractive, if $10,000 is attractive, $20,000 is attractive, you define it. Is it realistic? Well, this is where it helps if you talk to a professional trader and say, listen, this is the account size that I have. This is the risk that I'm willing to take. Do you think it is realistic to achieve this goal? And at the end, I'll gladly give you here my email address. Please shoot me an email if you want to have my professional opinion, if this is a realistic goal or not. I'll gladly help you with that. And it should have a time frame here. So is it the time frame if you say we want to make $5,000 a month? Absolutely, because we have 1 month. No. The second step, and this is what we're going to focus on today, is make a plan. But please, guys, don't get it upside down. I see so many traders who just surf the internet, and then they stumble across a trading plan, and based on this trading plan, they then try to define their goals. It works the other way around. It is always like this in life. You first define where you want to go, what you want to accomplish. This is step 1. And then number 2, you define how you will go there, how you will accomplish this goal. And this is what you will see might be slightly different what you hear today than what you have done in the past. Do not start off and first say, okay, I'm trading the E-mini S&P, and I don't know, I'm using the MACD, and then I'll see how much money I make. No, you first start with a goal in mind. And the great thing is, as a trader, once you achieve the goal, and this is something that you learn when you're working with me, you stop trading. You define a weekly goal, and we talked about it in our last session, and if you missed it, please watch the recording. The recording is available on fxstreet.com. Watch the recording. We talked about having a weekly goal, how important it is. Do not set a daily goal. Set a weekly goal. If you achieve the goal, stop trading. If I'm looking at trading logs of traders who are sending it in, I see many times that they have achieved their weekly goals already on a Tuesday or on a Wednesday, and then they gave back the money that they already had to the market. You see, typical overtrading. Having a weekly goal and having the discipline to stop trading, to start enjoying life, this is what we want to do as a trader, will help you to become more successful. Now, thank you, moderator, for posting the link here. So here you have it. You can watch last month's recording. The third step, you actually have to execute the plan. You cannot plan forever. Eventually, you will have to place a trade. You can do this on paper first, and you should do it on paper first. You should paper trade. Yes, you should backtest. You should paper trade and then trade with a small lot size. If you're uncomfortable trading futures contracts, you might want to start with the mini forex contracts, for example. There are many ways how to get started to get your feet wet, or you might just want to trade 10 stocks, but you actually have to execute the plan. Please make sure that you really have the discipline to execute the plan for at least 40 trades. If you do not place at least 40 trades, you will not know whether it's working or not. And this can be on paper or in a mini account, so that you're just putting a little bit of risk in the market. All right, let's move on. So developing a trading system is a step-by-step systematic approach and not as difficult as you might think. And this is why we are running through these 7 steps today. And if you want, please take notes. And we will use these 7 steps that I'm outlining today in our next session, which is at the beginning of March, where we will actually then develop a trading system. You want to use in the beginning a common approach. You see, you want to start with an idea. There are 2 main approaches, and we'll talk about this in a little bit more detail a few slides down. We have a trend following approach and a trend fading approach. And I'll present to you which approach is for what kind of trader. See, it is not true that necessarily a trend following approach is better than a trend fading approach. It depends on you. It depends on your goals. You see how important it is first to write down what are your goals, how much money you want to make, when do you want to trade, at what times do you have time actually to follow the market. Can you follow the market in the first 2 hours after the opening, or are you busy in another job so you just can follow the market in the evening? Markets behave differently, so it is very important that you first decide what you want to accomplish, and then we can decide how to accomplish it. Well, sometimes it helps just to look at charts and see if you identify some patterns. The breakout of the previous day high, the breakout of the previous day low. Look at different markets at different time frames, and you'll see, wow, this is a beautiful trending market. And we'll walk through a couple of examples here in our next session where we just look at a couple of markets and time frames. See, if you start off with a trading idea and say, I want to apply a trend following approach, let's say on the euro currency on 5 minutes. And you see, wow, it doesn't seem to work. It doesn't seem to trend really on 5-minute charts. Okay, you might just want to change to a different time frame, like 15-minute chart, and or 30 minutes or 60 minutes. And suddenly you see that this approach might be working. Today we have a plethora of places where we can get trading ideas. You have a lot of forums there. For example, fxstreet.com has a forum. You have elitetrader.com. You have tradeToWin.com. So these are 3 main forums where you can get some trading ideas. And every forum usually has a section about trading ideas or trading systems. And people share some ideas that they have here. You can also pick up any magazine, Active Trader, Futures Magazine, Stocks and Commodities. Every month they have a featured trading system. Do not expect that you just have found the perfect system that makes you $10,000 of dollars by picking up a magazine for $7. This will not happen. But what will happen is that you get an idea that then you can further develop, where you apply your rules and you test it. Don't try to take the shortcut here. I mean, trading, as said, is a business. There is some work involved. There is some planning involved. So you want to make sure that you have a sound plan. Unfortunately, in trading, we do not really have anything like a franchise operation like McDonald's, okay, where you just buy into McDonald's and then hooray, it suddenly is profitable. So you have to make your own plan, or at least know what you're doing so that you can evaluate somebody else's trading plan. Now the first step, or this is actually step 2, what you want to do, you want to select a market, okay, that supports your goals. So what are the 3 main markets that we have here? We have the futures markets, we have the stock markets, and we have the forex market. Now on the futures and in the stock markets, we also have options. So you could trade derivatives. That's a difficult word for Germany here. That's, by the way, the accent that you're hearing. Obviously, I'm from Germany. Derivatives. Okay. On futures or stocks. Or you can, of course, trade directly futures or stocks. So what are the pros and cons of these markets? Well, in futures, you have a high leverage. The leverage is typically 50 to 1 to 100 to 1. You have rather low commissions here, So per round turn, you're paying anywhere between, let's say, $5 and $8 per round turn. It really depends what kind of market you're trading, how big your trading account is, how many round turns you place. So this is where you need to talk to a broker and figure out what your rate might be. You have low margin requirements. You might have read it on the internet. You can start trading contracts like the E-mini S&P and the E-mini Russell for as little as $500 per contract. Well, I would not suggest that you open a trading account, a futures trading account with less than, let's say, $3,000 to $5,000, but some brokers will let you open this account with as little as $2,000. So futures, one of my favorite markets because you have a great opportunity for diversification in this market. See, once you have a futures trading account, you can not only trade the stock indices like the E-mini Russell, the E-mini S&P, the E-mini Dow, and the E-mini Nasdaq. You can also trade commodities like electronic grains, corn, wheat, soybeans. You can also trade the energies like oil, crude oil, light sweet crude oil. You can trade gold. You can trade silver. You can trade the interest rates, and you can trade the currencies. You see, you have excuse me. You have one trading account and can nicely diversify over a broad variety of markets. And I think right now, last time I checked, we have approximately 26 different markets that have a decent volume and are traded electronically, so that are easy and nice to trade. And don't be scared. A chart is a chart. If you talk to me, you will hear this again and again. I don't care what the underlying market is. If you have a solid trading strategy, it doesn't matter whether you're trading stocks, futures, forex, or options. Because a solid trading strategy developed the way how I'm going to present it to you and in the next session works in any market and preferably in any time frame. So one of the important steps that we're going to talk about later today is that you need to test it on multiple markets to make sure that you haven't curve fitted your trading strategy. If you are having a trading strategy that only works on the E-mini S&P, then most probably this strategy is curve fitted to this particular market. And as you know, markets change. Just take a look at the E-mini S&P. Volatility has doubled, even tripled since last year. Markets are more volatile. The same can happen to any other market. So this is why my personal favorite are the futures markets, because with one account you have a lot of advantages and can diversify nicely. Now what about stocks? Stocks typically have a low leverage. Unless you have a margin account, the leverage is 1-to-1. So this means for every dollar that you have in your account, you can buy $1 worth of stocks. Now, some brokers allow you to trade on a margin account, giving you a leverage of 2-to-1, maybe 4-to-1. If you have been with your broker for a long time and have a decent trading account size, let's say anywhere above $150,000 to $200,000, he might give you a leverage of 8-to-1. Well, compare this to the futures and the forex markets, where you have a leverage in the futures markets of 50-to-1, in the forex markets of 100-to-1, or maybe even 200-to-1. So you see, you have a rather low leverage on stocks. If you're interested in day trading, you need to know that there's a day trading pattern rule that was introduced a couple of years ago. I think it was in September and October 2001, where now you need at least $25,000 in your trading account if you want to day trade the stock market. So you see, especially for many beginners who want to start out and maybe just get their feet wet with anywhere between $5,000 and $10,000, this might anyhow not be the right instrument for you. Besides this, every day you have more than 10,000 stocks to choose from, so you have not only to predict the direction of the market, you also have to find the right stock. Now what about Forex? Well, you probably have already a lot of information about Forex. We are not paying commissions on Forex, but you know that there is a spread between the bid and the ask. Depending on the currency pair, this is anywhere between 2 and 5 pips that you usually have. So consider rather this as a sort of commission. So you're paying, or you're in a hole between $20 and $50 depending on the currency pair you trade. If you're not familiar with these terms, please look it up. There's a lot of information on Forex available, and fxstreet.com, of course, here is an excellent source for this. and you'll get a feeling for this. If you need more information, I think I somewhere have a special report on this that I'll gladly send to you if you just shoot me an email later on. Now, another huge advantage in the Forex, you have mini accounts available. So you see, this is actually when you make the first step from paper trading to trading live, you might want to start trading a mini account in the Forex. Well, this is of course not really to be serious about trading. It's not about to make money. It's about just seeing how do you react in real time when real money is on the line. And instead of risking maybe $100 on a trade, you just risk $10 on a trade. So if you lose, you skip the next Happy Meal at McDonald's or something like that. So this is an advantage of the Forex market. As I said, in the Forex markets now, you're again bound to only currencies. It is true that you have a bunch of currency pairs, but you know that we have 6 major currency pairs where you have a decent spread so that they're nice to trade. And for all these reasons, since I also can trade the currencies at the Chicago Mercantile Exchange, I'm a big fan of futures trading. But you see, this is how you approach it. You first start with an idea, and then you look for a market in which market this might be applicable. So if you have a trend following system, you take a look at different markets and see which market is actually a trending market. The major mistake that most traders make is that they have just one trading approach, that they are trading on one market. If you want to be truly successful, you have multiple trading strategies, and I personally have 5 different trading strategies that I can apply on any market I want. So you see, no matter what the market does, I am prepared and can trade it. So if you would just dump me right now in the middle of Hong Kong and tell me I'm only allowed to trade the Hang Seng Index, which I've never done before, I bet I would be profitable trading it, because I have my toolset of 5 strategies, so I just have to look at the index and see, is this market a rather trending market? Is it a market that is going more often going sideways? Is this a market, if it is trending, who has nice and long-lasting trends, or is it a market that turns around on a dime, so has a very small swing? And then you apply the proper strategies here. Now, after you have selected a market, you now select a time frame. And you know this, we have basically 3 different types of trading. We have the long-term trading, where you hold a trade a couple of weeks to a couple of months. We have a short-term trading, where you hold a trade a couple of days to a couple of weeks. And then, of course, we have day trading, where you hold a trade a couple of minutes, maybe to a couple of hours, and close the trade at the end of the day, okay, before the settlement here. Now, what about the time frame? What do you need to know? Well, as a rule of thumb, the smaller the time frame, the smaller the average profit per trade, and therefore, of course, the smaller the risk. If you're going down and if you're trading, let's say, the Forex market, and you're going down to 5-minute chart, you will most probably get away with a 10-pip stop loss most of the time, so you can apply a rather small stop loss. Now, if you're switching to a larger time frame, let's say Euro versus the US dollar, and you go on 60 minutes, you might have to apply a stop loss of 20 to 30 pips to stay in a trend and not being immediately stopped out. If you're going on daily charts, if you're switching to daily charts, you might have to apply a stop loss of 30 to 50 pips, again, depending on your day trading strategy. But you see the principle, the larger the time frame, the larger the stop loss, and therefore the larger the risk. However, on the upside, as you will learn, your profit target should always be larger than your stop loss. For my conservative day trading strategies, for my conservative trading strategies, I apply a profit target that is 1.5 times as big as my stop loss. So for every dollar that I risk, I want to make $1.50. For my more aggressive trading strategies that I'm using, I have a reward ratio here of 1 to 2.5. So for every dollar that I risk, I want to make $2.5. So you see, the larger the time frame, the larger also the profit potential, and therefore, thus, the larger the average profit per trade. Now, why is that important? And when we are talking about performance reports and how to evaluate your trading system, the average profit per trade is important because you need to make sure that this is enough to cover the commission and or the spreads, depending on the markets that you trade. Example, if you have a trading strategy on 5-minute chart, the D-mini S&P, and you see that you can only make average profit per trade like $8 and you're paying $7 in commissions, then you're just making $1 per trade. So you see how many trades you actually have to make right now with how many contracts to get a decent salary. You might as well be flipping burgers at McDonald's and have a better salary. So on the other hand, if you're trading the Forex market and you see that the average profit per trade, not considering pips or not considering the spread, is only $18, and you know that you have a minimum of 2 pips, which is approximately $20, then you have a problem. This trading strategy will not be profitable. So keep this in mind. Many profitable trading systems use larger time frames because you have a high reward, a high risk. Of course, then you have a larger drawdown and less trading action. I mean, automatically. If you just think about 5-minute bars, you have a bunch of 5-minute bars. I even have counted it in a day. But if you are trading the E-mini S&P and you switch to 60-minute bars, you just have approximately 6 bars per day, per trading day. So therefore, you obviously have fewer trading opportunities than on smaller time frames. Make sure that this fits, again, your goals. And you see how nicely this ties into your goals, where you first define how much money you want to make, how long you want to stay in front of the computer. If you just want to trade the first 2 hours in the morning, then probably you shouldn't trade on 60-minute bars because you just get 2 bars. How do you get an entry signal on 2 bars? That's quite tricky, wouldn't you agree? So if you trade just the first 2 hours in the morning, you might want to choose a time frame of maybe 10 to 15 minutes. My preferred time frame for my own trading, I'm using 15-minute charts. The reason why I'm using 15-minute charts is for my day trading. I get rid of the noise that there's in the market caused by the computerized trading, by the program trading, and by the scalpers. And it is big, or it is still small enough, so it is big enough to eliminate the noise, and it is still small enough that I can capture the nice trends that we have throughout the day. Now, many of my students, or some of my students, also like to go back to 5-minute charts, especially for stock traders. If you're a stock trader, you definitely want to look into 5-minute charts. But you see, again, this is why it is so important that you first select a market and then a time frame. All right, let's move on. So the third, quick recap here. So we start with an idea that you can get from the forums or the magazines or some books. James Altucher, Trade Like a Hedge Fund. You have 20 uncorrelated trading strategies in there. So there's a bunch of ideas, and I think the book is around 25 bucks, something that you might want to pick up. You then select the market and then select the time frame. Now, does it mean if you go through these 7 steps that automatically you have a profitable trading system? No, not necessarily. I mean, it's like a business plan. You might have a great idea for a business, and when you write everything down and the staff you need and attach costs to all the activities that you have to do, you see at the end, when you develop the plan, you might see that this is actually not a profitable business. Now, the same here when it comes to trading. It is just a very systematic approach. We want to systemize somehow the development of a trading plan here. So if you use this approach, this does not automatically mean that you will have a profitable trading strategy at the end. So you might have to go back after you go to step number 6, evaluate your system, and you see, well, these are not the results I expected. And you try to improve it and say, well, it's not getting any better. You might have to go back and change the exit rules, or you might have to change entry rules, or you might have to go, as I said, to a different time frame. Believe me, if your trading strategy that you have just developed does not work on 15 minutes, try 60 minutes or try 5 minutes and evaluate it. See if it changes. And you'll see, of course, a different time frame will produce different results here. You might have to go back then to the market and say, maybe this market is not right. Let me see if this system that I've tested here on the E-mini S&P would not work in the Forex markets, like the dollar versus the euro, for example. And if this all doesn't help, then most probably you have to go back and say, you know what, the idea probably wasn't that good. So you see, though it is a systematic progress, a systematic approach here, does not mean that it is a linear approach, and if you just go through it once, then automatically you'll have a profitable trading system. No, you might have to go through this several times. But it's again, it's like a business. This is the foundation of your trading success. And you know what they say, that you should what? Spend 90% of your time in planning and 10% of your time in execution? Well, I don't know about this, but you definitely should spend hours and hours and hours on your trading plan. Might be even days and weeks. Otherwise, believe me, if you just jump in the markets without a plan, and I've seen it plenty of times, you will lose money. Even if you might make money in the short term, in the long run, might use money. So let's talk about entry rules here. And you see, when it comes to trading, I briefly touched on this in the very beginning. We have two basic approaches. We have either a trend following strategy, and a trend following strategy means if prices are moving up, you buy. And when prices are going down, you sell. So this is the basic idea of a trend following strategy. Now, contrary, you have a trend fading strategy. A trend fading strategy means that when prices are trading at an extreme, for example, the upper band of a channel or the upper band of a trend line, then you sell and you try to catch the small move while prices are moving back into normalcy. And the same applies for buying. This should be buying here, okay, because we just talked about. So these are the two basic principles. You either have trend following strategies or you have trend fading strategies. Now, if you look around on all the trading strategies that are available here, you will see that we have many popular approaches that belong to either the first category or the second one. So what are popular approaches for trend following strategy? Breakout trading, like for example turtle trading. Turtles take the high and the low of the previous 20 bars, and if the high is taken out of the previous 20 bars, you buy. And the same applies then for selling. If the low of the previous 20 bars is violated, you sell. You find the turtle trading rules for free on the internet, so I don't have to go into this in detail. Take a look at it. This is a breakout trading. What else is breakout trading? Previous day, buying the previous day high or selling the previous day low. So if prices move above the previous day high, you buy. If they move below the previous day low, you sell. What else? A new 52-week high. If prices are making a new 52-week high, you buy. Popular stock trading approach. If they're making a new 52-week low, you sell. So you see, this is all breakout trading. Breakout of major support or resistance. What else? Moving averages. Moving averages by definition are trend following approaches. You can use a simple moving average. You can use exponential moving averages. You can use multiple moving averages, like for example a fast moving average and a slow moving average. So a 9 period and an 18 period, and trade the crossover. And another popular approach here is the MACD. So the moving average, convergence, divergence. What else? Parabolic. Wells-Walder's parabolic, for example, here. What are trend fading approaches? Most of the oscillators, like RSI, %R, are trend fading approaches because these oscillators or these indicators are usually measuring overbought or oversold situations. Bollinger Bands actually can use as trend following or trend fading. Many people use them as a trend fading approach, where you sell if prices are touching the upper band, and you buy back when prices are then hitting your profit target or maybe the lower band. Trend fading is also when you're selling highs, so you're selling the previous day high and you're buying the previous day low. Okay, and you hope that prices are staying in the range and do not break out. Now, as you can imagine, or as you might have heard, markets are only trending 20% of the time. So when is that? Usually markets are trending in the first 2 hours after the opening. You know that we have many markets that are open 24 hours. Let's take a look at the grain markets, for example. The grain markets are open now, the electronic grains, 24 hours. However, when do you see the most beautiful trends here? It is between 9:30 Central Standard Time and 11:30 Central Standard Time. During the night, not a whole lot is moving. So if you're trading during the night, you might want to use a trend fading approach. Same for the euro currency, euro versus the dollar. I mean, if the European and the US markets are closed, So basically for us here in the US, in the afternoon after 2 p.m. until 12 midnight, the market is not moving. It's usually just going sideways. So this is when you can apply a trend fading approach. You see again how important it is that you first define your goals, what you want to accomplish before you actually make the plan. Because if you say that you only want to trade in the evening hours, do not use a trend following approach. Most markets are dead, have a flat line, unless you're trading maybe the Japanese yen or the Aussie dollar. Okay? So make sure that then you're applying a trend fading approach. Now the great thing is, we don't have to worry about our entry rules too much, because depending on the approach that you choose, it already comes with predefined entry signals. You know, for example, RSI, what is it? If it goes above 80, you should sell. If it goes below 20, you should buy. Moving averages, the crossover, okay? From below, you should buy. From the top, from above, you should sell. You know how to use a MACD. So that's a great thing. We don't have to worry about our entry signals. And there's this famous saying, don't worry too much about your entry. I mean, a monkey can enter the market. Money is made and lost when you exit the market, right? So this is why we want to talk here a little bit about exit rules. But you see, entry rules, just as a conclusion, and I almost forgot that I had this slide in here. For trend following, you should have a time frame of at least 15 minutes, better 60 minutes. Typically a larger profit target than your stop loss, as said previously. For my trend following approaches, depending whether I'm trading my conservative strategy or my aggressive strategy, I might look for a ratio of 1 to 1.5 or 1 to 2.5. And when you're trend fading, see, some trend fading approaches even have a larger stop loss than your profit target. Well, they still make money because they usually have a higher winning percentage. So for a trend following system, it is not unusual that you see a winning percentage of anywhere between 50 to 65%, and very aggressive home run, hit and run systems here might even have a low winning percentage of only 20 to 30%. On a trend fading system, it is quite normal to have a winning percentage of 65 to 80%. Therefore, you typically have a stop loss that's equal to your profit target, or you might have even a stop loss that is larger than your profit target. Trend fading is great on smaller time frames. It can be great for beginners to get your feet wet. Typically, with trend fading approaches, you won't make a lot of money. But you see, you learn the mechanics of trading. And since you have a high winning percentage, it's good for your ego because you're right most of the times. And as you know, markets are trending only 20% of the time. So especially if you are looking, or if you want to trade in the evening hours, this is your system of choice. So what about the exit rules? We have 3 different types of exit. The first is stop loss. You want to get out if the market goes against you. The second, that we already touched, is you want to have a profit target. Good traders have a stop loss in the market. Great traders have a profit target. They know how much to expect from a certain move. So this profit target then realizes profits if the market does not move in your favor. And the third type of stop that you want to have is a time stop. Get out if the market does not move at all. Don't gamble. Right? If you had an assumption, for example, you have a trend following system, and your system says that you want to buy the breakout of the previous day high. Now you're sitting there and prices are moving towards the previous day high and they are breaking through and you go long. Now you're long in the market. No, nothing's happening. Now prices are just sitting there, don't move at all. So they dance around your entry price. They go a little bit up, they go a little bit down, but they don't move at all. 5 minutes go by, 15 minutes go by, 30 minutes go by, nothing happens. Have you ever experienced it, that the market just seems to be dead right now? Well, now obviously your underlying assumption was wrong, because your underlying assumption is if we break out of the previous day high, then we will quickly reach a new high and you should be able to realize your profit target. See, if the market does not move at all, get out. Rule of thumb, use 3 times your time frame as time stop. Example, if you're trading on 5-minute charts, use 15 minutes as a time stop. So get out of the trade after 50 minutes, even if your profit target and stop loss is not yet hit. If you're using 60-minute charts, get out after 3 hours. If you're trading on daily charts, prices are neither hitting your stop loss nor your profit target, get out after 3 days. So you see, just as a rule of thumb to get started. Now, what are the 4 different ways or 3 different ways how you can express a stop loss or a profit target? Well, you could have a fixed dollar amount where you say, for example, $1,000, and you can apply this to both a stop loss and a profit target. You could express your stop loss or your profit target as a percentage of the current price, for example, 1%. You could express it as a percentage of the volatility, for example, 50% of the average daily movement, or as a trailing stop, like 30% of unrealized profits or 70% of unrealized profits. You see, percentage of the volatility, and always you want to do a time stop. And a time stop is specified, obviously, in minutes, hours, or days. To keep it simple in the beginning, I would recommend that you use a fixed dollar amount or a fixed amount of pips to keep it very simple so that you don't have complicated calculations. And you see, I compare it to driving a car. If you can't drive a car with 15 miles an hour, you won't be able to drive a car at 200 miles an hour, okay? So if you can't make money with a fixed dollar amount on a certain strategy, you won't be able to make money if you make it more complicated. So try to keep it simple. Then later on, might want to use percentage stops. This is very important, especially if you apply the same strategy on different markets, like, for example, different futures markets. Obviously, some markets might be more volatile than others. So in some markets, you have to apply a smaller stop loss, and in other markets, you have to apply a tighter stop loss. So this is also where you use volatility stops. You have wider stops in volatile markets and tighter stops in quiet markets. And we have to move on a little bit quicker here, but we are almost done. We have just 2 more steps. Always use time stops, and we already talked about this. Now, when evaluating your system, you can either create your own performance report, and if you want to do this, I'll gladly send you an Excel sheet where you can log your trades. And then on the second page of this Excel sheet, you'll actually have your own personal performance statistics. So you just need to log a few trades, say at what time of the day you went in, with what price, whether you realized a profit or loss, and then it will calculate some key numbers. What are the key numbers that you need to know? Obviously, the first is the net profit. You want to see that you're making a profit. Second, and we talked about it briefly, is the average profit per trade. Make sure that trading is worth your while, okay, so that you're making some money here. Again, what else? You want to probably know, and let me just quickly deviate from it, the average profit on a winning trade and the average loss on a losing trade. See, you want to make sure, preferably, that the average profit on a profitable trade is larger than the average loss on a losing trade. You want to see your winning percentage, obviously. Want to know, do we have a winning percentage of 50%, 70%, or 80%? And you want to know your maximum drawdown. So it is very important that you come up with numbers that you feel comfortable with. You see, I, for example, like to be right most of the times. This is why I like to trade my conservative trading strategy, where I take money off the table quickly. I like to have a winning percentage of 70% and more. Just me personally. Now, you might be different. You might say, hey, I can go for 20% winning percentage as long as I make some money. However, then be prepared to have, I don't know, 8, 10, maybe 12 losses in a row before you hit the home run. That's not me. I'm not swinging the bat to hit a home run. I'm swinging the bat to hit the ball. Okay, so this is my goal. Whether it goes in the inner field, in the outer field, or whether I hit a home run, I don't care. I just want to hit as much as possible. Now, when you're swinging for home runs, then obviously you don't care whether you're hitting or not. You just want to make sure when you're hitting that then it really is a home run. So you swing more aggressively. You might swing differently. Well, now you have a German talking about baseball. How good is that? Anyhow, you want to select your comfort level. Last thing, after you evaluate your strategy, you can improve your strategy, your system. Make sure that you don't curve fit it, especially with today's software. It is so easy. You get a bunch of reports where, for example, you see, hey, my system, my strategy is really good. But on Thursdays, it always loses. I don't know why that is, but my software tells me it's losing on Thursday. So you start eliminating this, and you say, Do not trade on Thursdays. Now you take a look at your performance reports again and you see, oh, this system is always losing at the 12th of the month. So for no reason, you just say, don't trade on the 12th of the month. And you see, you start adding the so-called filters, and what you do, you eliminate all losses on your sample that you had from the past. Well, this, of course, means that you are curving your system to the data that you were testing it on. So never do something like this that without any reason or just because your performance report said you that you're not trading on Thursday, not on the 12th of the month, not in August, and blah, 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 and so on. How do you improve your system the right way? You add profit exits. If you don't have profit targets up to now, start adding profit targets. Take money off the table as soon as it is there. Add some stops or modify your stops. Use trailing stops versus the hard dollar stops versus $100 or $150. Use volatility stops versus dollar stops. And consider the system characteristics. For example, if you have a trend fading system, do not trade it when you have a major economic report or when the Fed does another announcement. You know that the market will move. So you know that your trend fading system gets chopped into pieces. On the other hand, do not use a trend fading approach when you know that the trend following approach, if you know that the market is not moving. For example, before a Fed meeting. We have seen it last week. The market was just going sideways in the morning. Everybody was waiting. So you see, this is, of course, what you can incorporate. Just make sure that you have a better explanation for it than just saying, hey, I did it because my performance report said so. All right, let's wrap it up here. Always make sure to avoid curve fitting, that you test your strategy on multiple markets. If you have a solid trading strategy, it should work equally well on the E-mini S&P, on the E-mini NASDAQ, on the E-mini Dow. If it is a great trading strategy, it will work as well. Also in the grains, it might as well work in the currency market. See, a true system considers the market the psychological factors of the market. Okay, this works in any market that is out there. So at least test it on related markets to make sure that you haven't curved it to the past. If necessary, as I said, if you're not achieving the results that you're looking for, and this is why you first want to define your goal, because you have to make sure, what do I trying to accomplish here with this exercise? Then you go back, and you go back step by step. This is what I said. When refining your system, you first start looking at the exit rule. By applying different exit rules, like, for example, profit targets or modifying the stop loss, can you make the system more profitable? But guys, keep one thing in mind, and then I'm going to really wrap it up here. The moderator will slap me on the wrists again because we have a session following here in a couple of minutes. If you started developing a strategy and the strategy is not profitable, chances are slim that by fine-tuning or improving it, it now suddenly becomes a profitable strategy. You can make a profitable strategy more profitable, but a losing strategy to suddenly make profitable, you probably have either the wrong time frame, the wrong market, or maybe even the wrong idea. So test your strategy, look at the results. If it is profitable but not to the point where you want it to have, start tuning entry and exit signals, okay, by adding maybe more filters, but filters that make sense here. Start applying some more exit rules and you might be more profitable. Or if it has not been profitable, change the time frame, the market, or maybe even the idea. All right, guys, we are done here for today. If you do have any questions, shoot me an email at support@rockwelltrading.com or visit our website at rockwelltrading.com, www.rockwelltrading.com. There are a bunch of free articles and resources available there. Thank you very much. This session has been recorded and will be available. I'll see you again in the beginning of March for the fourth part of the series, where we'll use these 7 rules or these 7 steps to actually develop a profitable trading strategy. You all have a great day, great afternoon, and thanks a lot, fxstreet.com, for having me here today. You have a great day, and bye-bye.